Joining me now to talk more about markets is Emons. He's a founder and chief investment officer of FedWatch Advisors. Ben, it's great to have you on the show this morning, and it seems like this momentum remains in the market. What's your perspective here?
Yeah, it's certainly a relief, Christian, because after the ceasefire was announced, the comments by Chairman Powell were friendly too. Yesterday he clearly opened the door to rate cuts. His tone was softer, I felt, than before, especially at the press conference recently. So I think there's recognition within the Federal Reserve that if these tail risks of the Middle East or the tariffs are now exactly playing out in terms of inflation, particularly, then the door is open for this rate cut. And I think that is helping this market. Because ever since these comments came out, the market really started to rally and take off. So I think this explains why we're in a good mood today.
What did he say specifically, the Fed chair yesterday, in that routine testimony, Ben, that could lay the groundwork for a sooner than expected rate cut?
Well, a few things. He laid out the paths. That is if inflation comes out a bit lower, if the tariffs effect are not so evident, or if unemployment is weaker, those are conditions for him to say we move forward with rate cuts. Because in applying that, what the Fed has put out as this projection would actually be materialized as 2 rate cuts in the forecast. Then he also talked about, like, if it wasn't for tariffs, actually interest rates could have been lower by 100 basis points from here. I think the market took that as a point of saying, so if the tariff impact isn't so material, as we've seen so far, and it's questionable if it is, then, yields should actually be a lot lower, or rates should be lower. And I think that it was for the market a bit of a link towards that could happen a rate cut sooner. Not sooner, though, I think he did lay the ground for the September cut, because he did say, Powell, that he expects tariffs to see most of the impact in June and July into August, so it makes the September meeting the most obvious meeting for them to cut rates. But nonetheless, it's a path that's a little bit changed, and I think that's now reflected in expectations.
Do you think that he has the timing right here? The Fed chair's had a lot of criticism, feedback in terms of whether or not Fed Chair Jerome Powell is acting on time when it comes to rate cuts, and I want to hear your take.
Well, if you strictly look at inflation and the Fed funds rate, and you're looking at over the last, say, 3 to 6 months, then that difference has got wider, meaning inflation has fallen, whereas the Fed funds rate stayed the same. And that has been their framework to say, well, the funds rate gets more restrictive, and as such, we could take off some of that restriction, and as we go along. And that actually also takes away a little bit of the timing issue in terms of, like, we should cut now because now is right now really important. Rather, it's more about we're on track to get a 2% inflation rate, and that allows us to cut the interest rate. So I think it's for Powell really that framework that he wants to stick by, because he is still cautious about whether inflation actually could turn around because of all the forces that we're seeing in energy and through tariffs potentially. Then again, the timing can always be challenged because the economy could suddenly weaken. So far, we've not seen that weakness coming through too much, and employment picture hasn't deteriorated much by anything. I think this is where the timing sensitivity is. So last year they addressed that in September by cutting more than expected because they saw the unemployment rate going up. And this time they're not sure about it. They're more looking at inflation. So it is still a timing issue, but they stick to the framework of if inflation keeps moderating, we can cut rates. I think that's what they will stick by.
Yeah. I do want to ask you about inflation, Ben, because the expectation, or at least what we had heard formally from the Fed chair, is that due to changes in trade policy, namely tariffs, higher tariffs on countries and global trade, the Fed chair had expected inflation to rise. We haven't really seen that in the data yet. How do you think that plays out in the months ahead?
Well, it could come through different ways. I mean, one, it could be really specific categories. If you recall through the pandemic, part of the reason why we had such a surge in inflation is because of used car prices. And those again are a bit under pressure as well. Or car parts like this are heavily imported and therefore being subject to tariffs. But it's also through input costs. There are PMI and other regional manufacturing surveys out that do indicate that input costs are rising. Those do feed into particularly PCE number that we're going to see in a few days from now. And I think that is where the tariff effect may be showing a more broadening than what we've seen so far, because it is really isolated. You do the analysis yes, there's some categories affected by it, but then you had lower airfares, lower hotel rates, you had lower energy prices, and it all was offsetting why the tariff effect hasn't shown up. So I think it could change, whereby we have to take note of that energy prices are up over the month, something now more like 10%, after the ceasefire. Nonetheless, that could still impact CPI in addition to the tariffs that are just there, but they're not changing, at least for now. So I think this is the dynamic of inflation. And lastly, if you think of expectations, if you look at the conference board number yesterday, the inflation expectations are still really elevated, 6%. They've come up from 7, but they're still elevated. That too, I think, is I'd say, force for inflation to go higher as a result of tariffs, because a lot of the expectations are based on tariffs.
Hmm. I'm curious, Ben, as to how this impacts economic growth. Do you have any forecasts on that, knowing that trade was a big topic here that drove a lot of the activity in the second quarter? And the second quarter we will see come to a close officially on Monday.
Yeah, you can tell, right, that if we had such a surge of imports, that our trade balance has shrunk a lot, and therefore the component in GDP that's called net trade has sort of flipped around. But we also see now that we went from a negative GDP quickly back to positive, because that's what happens when we get this technical factor of an import being front loaded, being sort of more import than exported temporarily. Eventually, it gets put back into GDP through inventory buildup. I think from here, it's sort of there's still a lot of inventory out there that's sort of being worked off. Maybe not a reason why we don't see the tariff impact yet, because a lot of that was imported before the tariffs, as Paul said. And then it's more a fact of like, does spending change from here as these higher tariffs do start to bite real incomes? And it's a little unclear, because in a way, we got no deterioration in unemployment significantly. And so it's really about spending from here. And I think GDP can stay something like in the 2 to 3% range for the time being, provided that we don't get escalation of tariffs again. It doesn't seem likely, but it could happen. And I think this is where the economy currently is. It's sort of hanging in there, trending, not far above the trend, so not too hot, but not like materially deteriorating either.
Mm. Ben Emons joining us remotely this morning from Washington. Ben, thank you as always. He's the founder and chief investment officer at FedWatch Advisors.